Hi, this is Linda Eedes, and this is an update for the RECM Balanced Fund, our Regulation 28 Balanced Fund, and looking specifically at the second quarter of 2017. So the fund retraced a little bit over the last quarter. It was down 2.5% after a very strong rally since the beginning of 2016. The fund is still up about 25% since the beginning of the year, last year that is, of course, and that's against a backdrop of a global market that was largely flat. If you look at where this sort of retracing came in the domestic portfolio, it was really in the industrial businesses that were more sort of domestically focused. Obviously, there was a lot of negative news about the domestic situation, a lot of political uncertainty, the Gupta emails, some concerns regarding the proposed new mining charter. Of course, we had at the beginning of the quarter the credit ratings downgrade. So there was a lot of volatility amongst those kind of more inwardly focused businesses. And that's really the part of the market where we have, on the domestic side, seen increasing opportunity. Those businesses have been through a very tough operating environment over the last few years. Their earnings are still quite depressed relative to where they should be through the cycle. Obviously, a lot of management has been changed in many respects, or has really sort of made the businesses a lot more efficient, sort of improved balance sheets, gone through sort of a really tough time to actually sort of position these businesses well for the future. And as those sort of earnings normalize and the cycle plays through, those prices that you're buying those businesses at today represent substantial upside. There is a lot of uncertainty in the market environment, not only locally but globally as well. And I think we firmly believe that the best way that you can cope with uncertainty as an investor is to build as robust a portfolio as possible, buying businesses which are priced as low as possible relative to their underlying intrinsic value. And you want to put as many of those in the portfolio as possible so that you're not dependent on any one particular stock playing out within a particular time frame for your returns to be sort of coming through as the cycle goes through. We know that the value cycle is still very much tilted in favor of value investors going forward. That normalization hasn't fully come through yet. We're still in the early stages, so that should still continue to act as a bit of a tailwind for value investors. And I think importantly, if you look at the last year and a half, the returns for the portfolio in terms of value opportunities have been in a market environment which hasn't collapsed. There's this perception that value managers need a complete sort of market decline or an early stage bull market to do well. And it shows that when that dislocation becomes extreme, that isn't entirely necessary. Those value opportunities can start to sort of unlock even with a backdrop that is quite similar to what we've seen actually over the last few years, a continuation of really a bull market driven by a few stocks. So turning now to the positioning of the Balanced Fund currently and looking at the overall asset exposure, you can see we're still tilted towards equities. We've got 54% exposure if you add local and global stocks together. We still hold quite a bit of cash, although we have been able to deploy some of that into the market over time. But the fund is still sitting with quite a big chunk in cash, 40%. If you look at the market environment and you consider sort of the risks out there in terms of overall valuations and the likes, I think that that level is appropriate for a fund with this profile. I think you want that buffer and you want that dry powder if you have opportunities which do come up with market volatility. We're still very cautious about increasing exposure to the traditional interest-bearing parts of the market, such as bonds and property. Yields just aren't quite where we need them to be to justify a much larger allocation, although of course we did increase it a bit sort of over the last sort of year or so. The overall equity allocation has decreased slightly over the quarter, and that's largely because we pulled back our exposure to various stocks that had strong rallies in prices. So those included stocks on the global side such as Rolls-Royce, Mail.ru, ALS, Alfa Laval, Coach, all of those we pulled back slightly. We took the opportunity actually to add stocks which were down, existing exposures such as HCI, Nedbank, which came under pressure with the other banks after the ratings downgrade, MTN pulled back a little bit, and Tesco as well. And we actually introduced a few new stocks, mostly on the global side, one on the local side. That includes Sports Direct, that's the UK retailer. That's faced quite a bit of margin compression as a result of the weaker pound. And along with many other retailers, there is a bit of concern regarding the impact on retailers generally in the UK. That's opened up quite a few opportunities in that market. And really our investment thesis also includes a re-rating on the back of a recovery in their underlying margins. That's particularly in the sports retail division, and we're expecting some positive sales growth through a very deliberate store investment and expansion program. We also introduced a small position to Porto Seguro, which is the third largest insurance company in Brazil. They're mostly focused on car insurance, where they've got the largest market share. They've got 30% there. There, it really is a play on the sort of vehicle sales cycle. Recently, that's hit decade lows in Brazil. Obviously, this is an emerging market opportunity. We are finding a few of those popping up on the radar. And the business is now trading at levels close to book value, when on average it's traded a lot closer to sort of between 1.5 times and 2 times book value. So we expect that to normalize as the cycle plays out. We bought Unica, which is the second largest insurance company in Austria. That business is undervalued due to the current pressure low interest rates in Europe are placing on both the capital and growth prospects for the insurance companies. And the difference with Unica is that it has a dividend yield of 6.7%. So whilst the timing of the interest rate cycle is uncertain, we know that it will turn, and you're being paid to wait for those conditions to improve. Life Healthcare is the new investment on the local side. That's the second largest private hospital operator in South Africa. They do enjoy quite a few competitive advantages in terms of particularly their licenses in the more favorable urban locations. They've been able to pass on a lot of the price increases as a result of our unfortunate state of public health care. So their margins have been fairly stable. The price hasn't pulled that back, but what's happened with that is that the valuation of the business has actually grown beyond the current share price. And at the current price, investors are getting value. They're getting excellent cash flow generation at a multiple which is lower than what they would normally have to pay for that. So if you look at the top 10 stocks, there's a real mixed bag of value opportunities. You've got investment holding vehicles such as HCI, RECM and Caliber, which we believe are still hugely undervalued and sitting on very good portfolios of assets. You've still got the two biggest platinum producers, Implats and Amplats. They were down during the quarter as a result of the platinum price being down in rand terms. We think that's the one part of the market which still has substantial upside on the resources front. The platinum price hasn't really played ball. It's still depressed, and it really needs to come up for those businesses to be economically sustainable. So we expect that to happen at some point, and those two businesses represent the best opportunity to participate in that value unlock. We've got telecoms company MTN, local bank Standard Bank. Of course, we've got chemicals group Sasol, and then we've got that turnaround situation in technology group Altron, which actually performed very well during the quarter. It was one of the top performers in the fund, actually. And luxury goods company Richemont, and then lastly, the Portuguese retailer Sona. So that's a good representation of the rest of the portfolio as well. Much more diversified portfolio. And if you can find the right stocks across different sectors and themes and geographies, that's always more desirable than one that's obviously highly concentrated. So to conclude, looking at the RECM Balanced Fund, it's a nice robust portfolio. It's got a nice mix of underlying value opportunities. Still got quite a nice chunk of cash, which will protect it if there is a lot of sort of market decline, if there's some sort of capitulation there, but which also provides dry powder if we want to invest in new opportunities. And then also we've got a tailwind in the form of the value cycle turning, which RECM is both willing to take advantage of, being value investors. We've been through the difficult part of the cycle already, and we're able to take advantage of that, not only with regards to the large caps that are undervalued, but also a lot of small and mid caps, which quite frankly aren't available as opportunities for larger asset managers.